Hey everyone, welcome back to another episode of QSBS Solved. We're back from a few months hiatus where we've really been working on a number of cool projects, most notably the 2026 QSBS Summit, which is planned for late September in Jackson Hole, Wyoming. It's really the first national gathering to discuss QSBS and all the planning opportunities associated with it in a large group format. We're really excited to host this conference for the QSBS community and hopefully multiply the number of people who are engaged in what I think is really a growing QSBS advisory landscape. Of course, if you'd like to learn more about the 2026 QSBS Summit, you can check out the link to the conference website in the episode description. But our first guest back from this break will actually be joining us in Jackson Hole for the summit. I'm excited to have Doug Brody, who is president of Symphony Tax at Symphony Risk Solutions, on today. Doug's a great partner in the QSBS space, and we're actually currently working on a client project together, which is, I think, really definitely demonstrated to me the value of Doug and his team's expertise in this space, as well as the value of tax insurance in the QSBS space in general. So, Doug, thanks for joining me today.
Absolutely, Brady. Thanks for having me.
Yeah, we're talking about insurance today, tax liability or tax risk insurance. Can maybe just give a high-level overview of what Symphony does, just high-level overview on what insurance means for your day-to-day.
Yeah, absolutely. So again, happy to be on here today and to be working with you as well. Symphony Risk Solutions, we're a top 100 small but fast-growing brokerage. About 200 people here, formed about 6 years ago. I joined Symphony about 18 months ago and president of Symphony Tax, so I lead the tax insurance business here. Symphony is a private equity-focused brokerage, so we are industry-focused. We have industry experts throughout our programs, and we tend to focus on lower to middle market private equity. We obviously serve all clients, but that tends to be our focus, how we're built and how we go to market. As that relates to QSBS, right? There's obviously venture capital and PE-backed companies that fall within the QSBS space, but I also serve family offices, investors, and large companies that started off small enough to fit within our bandwidth.
So if someone hasn't heard about tax insurance or insurance associated with maybe complex transactions or things like QSBS, how would you, at a sort of a cocktail party, describe why someone would get tax insurance, what it is, and maybe a couple examples of instances where it's used in those areas?
Sure. I mean, I'll start off with the fact that if I'm talking about this at cocktail parties, I may not be invited back, but let's just assume for the moment that it's the right cocktail party setting for this. So tax insurance is what it sounds like. It's just, it's not a very well-known product. So it is literally insurance to protect against an unexpected, unforeseen, or unwelcome tax outcome. So you take a position on a tax return, or you anticipate taking one, and you're concerned that you might be audited and that audit might be successful. You can obtain insurance that if there is a successful audit and you have to dip into your pocket to pay additional taxes or audit defense costs or interest and penalties, you can also make a claim on this policy to reimburse you, to make yourself whole. It is not compulsory insurance, unlike life or auto or health. You're not required to get this insurance, but it's a cost based on a percentage of the overall coverage you're looking for. And this is issue by issue, so you're not looking for annual coverage or lifetime coverage. It's one specific return position. How much coverage do you want to cover the additional cash tax risk, interest, penalties, audit defense costs, and a gross up for income taxes? And then you pay a small percentage of that as your one-time premium. And now you can go to sleep at night knowing that either you won't be audited, or if you are, you have complete protection for the downside risk of a successful audit. This could be federal, it could be state, and in certain circumstances outside of QSBS, it could be cross-border or non-US taxes as well.
And so, we're obviously talking about QSBS a little bit today, but you provide, you can procure policies across a broad range of tax issues. And I assume that there are some in your practice specifically that you do much more of than even QSBS specifically. So what are the maybe like couple main issues that you guys focus on or tend to see, for instance, in the private equity space?
Sure. Yeah. So I'm a former, Big Four tax advisor. And so I've done due diligence and tax structuring for my entire first career of about 21 years before I came into insurance. And so I've seen a lot of M&A issues that come up. They can all be a bit unique, but you'll see a lot of issues that come up around S corps, their characterization and conversions into and out of S corp status. That does come up for QSBS as well. We see a lot of cross-border transactions and issues where, assets or businesses are moving from the U.S. out or from out into the U.S. and there are tax consequences associated with that. And then there are just positions that people take that are just unclear. Is something debt versus equity? Is it a distribution or is it a dividend? Things of that nature where it's very hard to get to tax certainty. It's almost impossible to get to tax certainty. And so buyers and sellers will often haggle over purchase price adjustments or escrows or indemnities. And those are all very cost inefficient, right? A purchase price adjustment is going to be very costly to the sellers, great for the buyers if they can get it. And indemnities and escrows are just very difficult for liquidity, which is very important to private equity funds that are trying to distribute sales proceeds to their LPs. And so insurance is a one-time way to just pay an upfront cost and absolve themselves of that liability so that all of the proceeds of the sale after the cost of the insurance can then be distributed without having to reserve for an escrow or indemnity, for example. In the QSBS space, we see lots of issues, and we'll get into those. But I think the way to think about it is you're anticipating taking this position either as a sale or as a rollover, and you have some concern either because an advisor or your own knowledge presents a risk point. There's just something about the transaction that gives you some concern, or it's just a very large number on a return, and you're trying to do your post-sale planning with the proceeds that you've just received, and you don't want the overhang of a very, very significant audit cost should you lose on audit sometime in the future. And so for a small upfront cost, you're willing to just put that risk to bed.
And I think maybe for our PE listeners who are more comfortable and more familiar with complex transactions or just transactions in general, it doesn't even have to be particularly complex, I suppose. Some of these things maybe are common knowledge, but I know, for instance, for many of our founder clients who are maybe selling a large portion of stock for the first time or who are going through a significant M&A transaction for the first time, a lot of people think about tax and audit risk in very binary terms.
Yeah. You're
either doing something correctly or you're doing it incorrectly, and the IRS is going to get upset about it. But there's a very broad spectrum across, how do you interpret the tax code? How do you apply it after you interpret it, of course? And so, it's not always that, hey, we're taking a position that we think is wrong. It could just be we actually just don't know how the IRS may respond to a certain set of facts or circumstances because there's just not enough data out there. So, there are more clear and less clear scenarios where you might bring a policy to bear on a transaction.
You make a great point, Brady. This is insurance here, similar to kind of all insurance, if you think about it, is not to protect risky behavior, right? You don't get auto insurance to drive into a tree or health insurance to jump off a building. And similarly, you're not getting tax insurance to take an incredibly risky position with insurance as the backstop. But as you well know, being a part of QSBS advisory groups with me, that we can sit around a table of very experienced QSBS advisors and debate. How does this provision apply? How does this fact pattern fit within a law that was written at a very high level where we have very detailed facts? And reasonable minds, I believe we're all semi-reasonable, differ on the outcomes a lot of the time. Doesn't mean that any of us are necessarily right or wrong. And it also doesn't necessarily mean that the IRS agent reviewing a particular transaction is going to agree or disagree with us. So especially for anyone in the audience that is an experienced tax professional or taxpayer, you never get certainty around tax. But in this area, there's just a lot of uncertainty because the laws are written at a high level. A lot of them are written a decade or earlier ago and don't take into account, changes in environments and industries and business activities, types of equity, types of structures, et cetera. And the government is not intending, at least in the QSBS space, to attack founders, to attack advisors in transactions. This is a permissible area of the tax law where they want to facilitate good transactions. But as we've seen already, there are some nibbling around the edges about trust stacking and other things where the government said, hey, we want to be permissible, but not that permissible. And so if you've exited or about to exit a transaction and you're staring at a very large exclusion on your tax return, there's reasonable worry, even if you've done everything right, because you don't know the experience level of the auditor. You don't know how they're going to interpret certain facts in the past of the issuing company. And you also just don't know, if they do issue a notice, how it's going to, how it's going to play out. And so having that certainty is often something that a risk-averse taxpayer would like to have.
And the reality is, when you have an area of the tax code like QSBS where there's a lot of gray area, it so happens that the most opportunity perhaps exists in that gray area. And so it's good to wade into that space with a policy that can help support you and also allow for just more creative or potentially creative and more complex types of deal structuring or planning around that, right? Things that maybe if you didn't have the backstop, we just wouldn't have enough data to be comfortable with.
I think it's definitely an area where working with your advisors and working with me to the extent that that you bring insurance into the fold, there is an amount of interesting tax planning that can take place. We're not talking about high risk tax planning, just creativity, where if you're an individual founder, you may not just have the experience to know what
Correct.
could I be doing, what should I be doing to maximize my benefit, whether
Yep.
it's in a rollover setting or in a sales setting.
A lot of times what we see is things weren't done 100%. Well, almost none of the time are things done 100% the way that we would like them in an ideal world up until the transaction. And so sometimes the complexity or the gray area comes into like, hey, we wish that it had been done like scenario A, but kind of we have scenario B here. And we want to make sure that the way that we're explaining why, maybe there was an oversight 6 years ago, or there was a conversion that was done a certain way 3 years ago, that we can, take a strong position to still get the client, potentially get the client a benefit that they still may very much qualify for or deserve, but the facts are a little bit challenging to present. So I think we run into that a lot with founders of startups who, there are many aspects of, for instance, bookkeeping and corporate governance that don't get fully sorted out and well documented until a few years down the line, and that's totally reasonable. And I think a good use for, when I think something I've been impressed in working with you has been that it's not just, hey, here's the facts, now go shop it around to issuers. We're working together to put together a package that is, one, extremely clear to the issuers that we're going out into the market to see if we can get a policy from, but also helps the founder to clarify, or the shareholder to clarify their documentation and to sort of get all of their ducks in a row before the transaction even happens, perhaps, which is, I think, really valuable.
Yeah, I think if obviously you recorded the old QSBS podcast, but in listening to them, there's a lot of focus on the documentation that should be done, both in an ideal setting and then what you're likely to actually see in real world. And there is that incremental additional support that you likely would need in order to pursue a tax insurance policy. But as you point out, it's often the case that these founders and investors have support at the initial level that may be their historic accountant, their historic attorney that is helping them through their early ownership of QSBS, but they're not as sophisticated as the advisors that we typically work with in this space in order to get them to the tax return position and or insurance. And so things can sometimes get missed or poorly or undocumented or just raise some concerns early on that may not be able to go back and be fixed in the sense of undoing transactions and redoing them, but explaining both the history as to why was it done in this kind of way that we wouldn't, as experts in the area, think to do, but also why it doesn't impact the tax result.
Correct.
Because if you do something that's kind of left or right of standard, you do run the risk that an auditor is just going to say, this isn't what I was expecting you to see, and therefore there's a bad result. So having, advisors and brokers that can surround them to say, we understand it's unconventional, but this is why it still leads to the right answer is very, very helpful and just, significantly reduces any risk.
And there are a number of sort of formal steps in the process to actually going to market to procure a policy. One of them, perhaps in a lot of transactions, is to get something like a tax or legal opinion. And so maybe you can talk a little bit about that process, sort of the standard that's required, the certainty standard that's required to go into market, and just the steps that you take to coordinate that process.
Yeah, absolutely. So, I mean, typically speaking, when you're working with an attorney, if you need documentation to support a position, often the case is I need documentation for a file or to satisfy a debtor, or I mean, a creditor or other stakeholder, or I want to protect myself against penalties if the IRS were to assert them. And so that position from the law firm or other advisor is typically going to be at a substantial authority level, meaning you have substantial authority to take this position. They cite that authority. You have your documentation. You take your position. You're protected against penalties. The problem is that substantial authority level, as interpreted by the IRS and other tax advisors, means you might have substantial authority, but it doesn't mean it's a good bet. It doesn't mean that you've necessarily convinced either the advisor or the IRS that it's the right answer. And so to get insurance, typically speaking, you need the advisor to reach a higher level of comfort that it's more likely than not, meaning it's a greater than 50% likelihood that if challenged, if audited, that you have taken the right position and you will win on audit. There are higher levels of standard beyond above, more likely than not would be should, meaning if you're challenged, you should win, stronger likelihood. We as tax professionals tend to put these into percentage bands. So more likely than not means call it 51 to about 70%, and should would be about 70 to 85% certainty. Now, notice there's a lot of risk still there. So even if an advisor were to say, you should win, they're still implying about a 15 to 20% risk that even in that circumstance, you might lose on audit.
Yes.
And so the first thing you need to do when you're going out to seek documentation to support your QSBS position is, am I working with an advisor that does these types of opinions, that is willing to issue a more likely than not or should level opinion in support? Because a lot of law firms work either without tax opinions or in that substantial authority realm, and they're not comfortable going beyond that because they've just not been asked before. They don't have the internal procedures to get comfortable with the difference in the amount of analysis and documentation it takes to get to that more likely than not or higher level of comfort. And they'll simply say, we don't do that. And now, as a founder or investor, you're left saying, well, what do I do now? And so there are a lot of advisors, as you know, I've worked with many of them who can get to that level of comfort in the right circumstances. And so the first key is finding the right advisor to support you. It may be more than one. So if your issue is not one of law, but it's one of valuation, the aggregate asset test, for example, under QSBS rules, then your advisor, your key advisor may not be a law firm or a tax firm. It may be an appraisal firm. And making sure you have an appraiser that understands the QSBS rules and what needs to be done and documented. So the key here is starting from the premise that the insurance markets require a little bit more certainty and clarity than you need simply to protect from penalty imposition on a challenge from the IRS or a state tax authority. But then also understanding, okay, beyond more likely than not opinion or beyond, an appraiser that can understand the aggregate asset test, what else is necessary? And if you listen back to the QSBS Solve podcasts, the ones you've done with Frost Brown, for example, there's a lot of strong documentation that's needed about the business conducted, when the shares were issued, timing, value at that time, the history of the business, when it became a C Corp, et cetera, redemptions. There's just a lot of facts that need to be gathered. And I strongly advise the founders and investors to gather those facts before the exit, because it starts getting a little bit tricky to gather them afterwards, especially if you're dealing with corporate level documentation and you no longer control the corporation. It just gets harder to obtain. Usually there are cooperation agreements that will allow you to at least request that information, but you no longer control timing, for example. And so that's at least an introduction to exploring the insurance process, but obviously it gets more complicated as we move along in the process.
Yeah, and I think a not insignificant part of what makes that process somewhat complicated, and sometimes it can even make getting a higher level authority opinion complicated, is simply in the QSBS space, the lack of clarity that we have around how Section 1202, maybe Section 1045 can be applied.
Mm-hmm.
We have obviously the text. We also have a few private letter rulings and hopefully Treasury regs coming on things like stacking in the future. But correct me if I'm wrong, but I believe one of the challenges to getting to, say, a should position with QSBS is that we simply don't have much to cite to demonstrate that we know exactly how the IRS thinks about both interpreting and applying some of these standards. Is that a correct way to categorize it. And before you answer, the reason I mentioned that is because when we talk to clients about tax or legal opinions, it's sort of this like, well, if we did things right, we did things right, and it should be sort of extremely clear. And sometimes when we mention sort of the like a more likely than not standard, they're like 51% or 70%. Like we can't get to a stronger position than that. It's not always just because of maybe slippery facts associated with the transaction. It could just be the nature of the information that we have available to us to make those guesses and assumptions.
Yeah, it's a great point, Brady. Typically speaking, the reason why an advisor is not getting to a should level and is sitting at that more likely than not level is not because of some, high risk thing that happened in the past, but more likely, as you mentioned, just the lack of direct authority on point. So a key example is, there's a list of the businesses that do not qualify, right? Yeah. I do not qualify as an insurance business, right? Advisors don't qualify, architects, doctors. But then there's a lot of businesses that are in the periphery, right? Mm-hmm. I'm not a doctor, but I'm involved in medical supplies or medical billing, right? I'm not the insurance broker, but I provide the software that they use. And so understanding, where the active business qualification rules are is very difficult because all the statute tells you is what doesn't qualify. Yeah. And so how do you get to certainty on what does? S Corp to C conversions or partnership to C conversions, often they could be done in a manner that's quite clear under the law. And then there's a lot of ways to do it that are pretty clear under the law. And most of the time we're living in that pretty clear land. Usually when it comes to aggregate asset value, we're hoping you're not bumping up against 50 million or 75 million, but often there's a timing element where you get issue shares on September 1st, and then something clearly happens on September 15th that changes the value. And so understanding, are those shares issued on September 1st? Can we get comfortable that the value is the value 14 days earlier than this major event that changed the value of the company? These are all areas where no one is trying to introduce or take significant risk, but there's just no way for an advisor to state with any level of certainty or confidence that the IRS is absolutely going to support the transaction as executed, knowing that there's just, uncertainty in the law.
And the reason that, you mentioned penalty mitigation before, and we've talked about this on, actually, I believe with Chris Carahali, perhaps on a past podcast we discussed, and we've talked about it with FPT Gibbons as well. Sort of this idea that, penalty mitigation, the IRS doesn't want people just sort of checking boxes and making elections all their tax return without talking to a professional. And so just with regard to penalty mitigation, seeing that, hey, I had an advisory team with me, I have sort of a letterheaded memo from a tax advisory or law firm that has, done deep diligence on my situation. Just that level of sort of preparation and foresight and diligence can protect from things like penalties being levied against the taxpayer, regardless if insurance is procured or not. That's a step that someone can take if maybe their concern about their position doesn't yet rise to the level of, I want to go and get an insurance policy as well.
Yeah, I think it is interesting because I think most folks in the audience probably aren't that familiar with tax insurance. And so understanding when should I be considering it, it's not typically speaking going to be because I'm afraid of penalties, right? Because if you need a tax opinion to support insurance, that tax opinion is likely going to protect you against
penalties anyways, yeah.
But it will not protect you against interest, which oddly enough is still at a pretty high rate considering where interest is in all other areas of the economy. So the government's not giving you, any deductions on the interest.
Yeah.
And then, of course, you have the states as well. And so if you're not living in a state that doesn't charge tax, you're inviting on an IRS audit, the state audit that tends to follow. And so the costs can start to rise.
That's a great segue from, hey, if you just need penalty mitigation, you can get a tax or legal opinion, but there's many other risk factors and things that, for instance, an insurance policy specifically will be able to cover. So maybe you can name the types of things that would be included as covered under one of these policies in most situations.
Yeah, I mean, we always start with the cash tax exposure. So if you just start with your, standard $10 million exemption from, pre-July of 2025 and a 23.8%, federal long-term tax rate for capital gains, you start with that $2.38 million of cash out of your pocket if you're wrong on the $10 million exemption. Then you can add in interest and penalties. As we talked about, penalties usually we can exclude here. And so you'd have the interest component. Contest costs, so audit defense costs can be covered under the policy. The tax insurance industry over the last 5 to 7 years has put a standard deductible against those contest costs as audit defense costs. And so typically speaking, the first, call it 250, 300,000 of those costs out of pocket will have to be borne, by the insured before they can start getting reimbursement. But that can be negotiated. And then often we'd say, okay, for an individual, it's not likely that we would exceed that deductible. So we just won't include capacity in the policy for audit defense cost reimbursement. But then there's a large one for gross up. So if you get tax insurance and you lose on audit, and so now you're getting that $2.38 million check, maybe grossed up for interest, for example, that check is likely taxable income to the insured. And so if you have to pay taxes on that check, you no longer are made whole from the amount you had to pay the government. And so if you have the right capacity in your policy, you can also get a check for the gross up amount. So you're fully made whole. So those are all of the costs that can be covered by the policy, in addition to the state tax. If the states follow the federal rules, there should be no additional incremental underwriting fee or other costs associated with the state tax. But if the state doesn't follow the federal rules, and you want the state tax to be covered as well, there may be an additional underwriting fee for the underwriters to bring in state experts to be able to review that different law and get comfortable underwriting it.
When we think about fees or the premium paid to acquire a policy, do you see a really standard rate across the industry today? Is there sort of a wide degree of variance? And what does that look like differing between maybe an individual with a relatively smaller policy versus maybe a sponsor, private equity fund, or other, an institutional investor, taxpayer, perhaps, who is seeking a policy maybe, high tens of millions of dollars or more?
Yeah. So I think the way to think of it is not just institutional, right? It could just be a group of founders or a group of investors that are that have kind of common interest and common facts. Right. It's certainly easier and more consolidated when you're dealing with a private equity fund with LPs, but it's not always the case that it's going to be PE owned. So the way to think about it, right? If we start with that 2.38 million cash tax on 10 million, add in a state component to it. I typically just round up the 23.8 to 30% just to make the math easier, right? So now we're looking at about a $3 million cash tax exposure. Interest, you have to figure out how many years and at what rate, but let's just assume, 6% over 5 years, so just call it a 30% rate. So now our 3 million cash tax exposure is 3.9 million. And now, add in some component for, a gross up for income taxes. And so you might be looking at a $5.5 million policy to cover what you originally thought was 2.38 million. And the way I think about this is, as the investor, as the insured, your risk is not 2.38 million. As we just described it, it's essentially 3.9 million. Because if you lose, you're likely to lose the federal, the state, and the interest. You would not lose that gross up amount, right? If you don't get insurance and you're not getting a claim check, you don't have to pay out of pocket for that gross up. So you're looking at an exposure of about 3.9 million. And the cost for that policy, and this includes the one-time premium, the underwriting fee, and then an estimate of the cost for a tax insurance policy to cover it, is about $390,000 to $400,000. So for that one individual with a $10 million exemption, you're looking at about a 10% cost. So not insignificant, but in answering your question, you'll start to see where that cost reduces. So now let's assume there's four individuals or 4 LPs or 4 investors that are all within the same fact pattern. They're all looking to obtain that same $10 million exemption. So one might think we just multiply everything by 4. But there are some benefits here. The underwriting fee is not multiplied by 4. And the tax insurance fee is not multiplied by 4. And so if you play out the numbers, so now we're looking at the out-of-pocket cost on an audit is 4 times the original amount. So that's pretty easy to figure out, about $16 million. But the cost drops from 10% to about 6.75%. So now all of a sudden, for 4 individuals with a $10 million exemption, you're looking at a rate that's significantly lower. And then if you double that again, the cost gets a lot closer to about 6%. And so as the numbers increase, the cost decreases. Going back to the numbers we talked about earlier in terms of risk profile, none of these numbers are adding up to the risk profile of even a should level opinion. So as I mentioned, the should level opinion still implies a 15 to 20% risk. So at most, what we're talking about is about half of the risk that's still left over in a should level opinion. And most of the time, we're not getting should level opinions here. But as you see, as you start combining insureds or increasing the amount of exemption, whether that's through stacking or the 10 times basis rule or otherwise, or rollover, for example, you start seeing some very significant economies of scale. And then just to remind the audience, this is a one-time fee. So you're not paying this annually. You're not paying this ever again. You pay it once, and then you have the insurance policy. And that policy, I mentioned 5 years for interest, but the policy will actually last 7 years, which is longer than an insured would ever need to get protection here. So within 7 years, if you have a notice from the IRS saying we're looking at this issue or we're going to examine the issue, you file your claim then, and now you do that within 7 years, and now however long it takes to resolve the issue, you have your insurance protection.
This is sort of arbitrary number that we use at our firm, but I typically think around the $8 to $10 million in sale proceeds. So in the range of dollars that you're talking about, maybe between 2 and 3.5 million if you include state tax liabilities, where these policies, I think, really start to become extremely economical from a, if you have a $1 million gain, even underwriting fees may make getting an insurance policy not economical, but certainly for a lot of even secondary sales that we see today in fast-growing AI companies, for instance, where you have maybe 3 founders taking money off the table during a fundraise, could even rise to the level where it becomes, extremely economical to pursue an insurance policy, and it hasn't even been a full exit if they're claiming QSBS at that stage.
Yeah, we're not even factoring in account just the risk adverse nature of the insured, right? If you're willing to take on significant risk and you're comfortable with that, then maybe this isn't a product that you need. And so often we will see groups of investors with the exact same facts, but some will opt out and some will opt into the insurance policy.
Sure.
Nothing prevents them from doing so. But you also see a lot of risk averse investors that would say, hey, I got a should level opinion, but I'm just not interested in carrying around that 15 to 20% risk for the next 5 to 7 years. And so even though I'm only an individual and this might cost me closer to 10% than that 6% that Doug was talking about, 10% still leaves me 90% of my benefit without any significant risk going forward. And I'm comfortable with that cost.
Yeah, it's like a sleep at night question, right? What makes you feel comfortable?
Exactly.
And that certainly varies per individual. That definitely varies per individual.
Yep.
That's the really good overview of sort of the process of what's needed and what goes into these policies and procuring them. Talk a little bit about as we wrap up your level of involvement just as an advisor alongside clients that you work with, as well as your ability to, just based on the sitting sort of in a neutral ground between a lot of other practitioners in the QSBS space, how it is that you tend to collaborate with other folks. I mean, I can speak to that firsthand, but would like to hear sort of how you think about collaborating with other advisors in the space.
Absolutely. Yeah, I become much more involved in these transactions than a typical broker, in part because of my many years as a tax advisor, and in part just because I get emotionally invested in the outcome. I really want my investors to really feel that sleep at night protection, and the cold kind of I've taken documents from one party and handed them to another party doesn't produce that level of comfort. So the first thing I'll do is understand from the client, kind of where are you at in the process? If you don't have a tax opinion, if you don't have but need an appraisal, for example, I can help you get that. I know hundreds of advisors that work in this space that are comfortable writing these opinions and doing these appraisals. And so I can, conduct RFP processes or help make introductions to get the investor closer to the advisors that they need. I will review in detail all the work that's handed to me and provide suggestions. So for one example, on a QSBS transaction I worked on, I got a more likely than not opinion and went back to the advisor and said, you wrote this well, but I believe that if you change this assumption to a representation, if you added a few more sites here, I think you can get this up to a should level. And I think the market would really appreciate that level of certainty from you if you could provide it. And we put the work in together and improve the opinion to a should level. That type of work is not typically done in the tax insurance brokerage space, but I feel it's a service that I can provide and enjoy providing for my clients. And then throughout the process, I work very closely with the underwriters to make sure that they understand these are individuals that don't have the bandwidth for a significant amount of Q&A and back and forth. And so if a request comes, hey, can you provide this document or can you answer this question? The first thing I'm going to do as a gatekeeper and say, why are you asking? Is this necessary? Tell me what you need this for. If you really need it, and the investor's going to, be able to go get it, sure. But I can sometimes cut a lot of that off to say, I understand why you're asking, but there's no way it's coming. Or I understand why you're asking and I disagree with the question. So let's try to cut this off without bothering our otherwise busy investors. As you well know, a lot of these serial entrepreneurs are on to the next business, they're on to the next investment, and they're not looking to be dragged into significant conversation or documentation requests from the insurance market. So that protection that I provide both to the underwriters to make sure that they're getting high quality work that's been reviewed multiple times before they even see it. And then on the insured side, making sure they're protected from a lot of the noise of the process, I think is the key element that I provide, in addition, of course, to the bound policy.
Yeah, and perhaps that's a feature of sort of the boutique brokerage space, but I see it really as a unique feature of the way that you guys practice and obviously the way that you individually practice, which is something that we've really appreciated. And I think, like you said, is a founder, for instance, not wanting to get dragged into a bunch of paperwork and complexity is one of the biggest barriers to doing this type of planning. And so eliminating that barrier in the way that you do service, I think is, really great and really important. To wrap up, I suppose, is there anything that that we haven't covered that you want to make sure that we get into to talk through, either if you're thinking private equity and some of the other focuses of the firm, or on QSBS specifically, maybe with founders or shareholders? Is there anything that you'd like to sort of leave the audience with in either of those camps?
Yeah, I think it's a similar message for both, which is we're talking about taxes here, which is a language that a lot of people don't speak. They may know a few words. They certainly don't speak it fluently, and they don't want to, right? I think tax issues scare people. They don't excite people unless you're in my industry. And so you do not need to figure out all of the tax issues, all of the facts before you pick up the phone or send an email. All you have to do is think you own QSBS and have some concern or risk, and that's all you need to get things started. I think that people tend to feel like, I don't know if I need insurance, so I have to figure that out before I call an insurance broker. That's absolutely not how I operate. And so I work with advisors and with holders sometimes as they're getting into a QSBS investment. They just say, hey, help me understand what are you going to ask me for in 5 years when I exit so I could just get started. And so what I think the message I would leave people with is, you don't need to be the one worrying. You don't need to be the one figuring everything out. All you need to know is this may be something I might be interested down the road, and we could start the conversation.
That's great. Yeah. And I think that because, Doug and I, we're very similar. We sort of sit at a cross section of a lot of different advisors in the QSBS space and get to talk to a lot of founders and shareholders just inbound. And so I think a lot of times we're playing point guard also, making referrals and pointing people in the right direction based on our own just sort of assessment of what the needs might be. The Doug's email always open, our email always open. Doug, this is a great overview of tax insurance. Thanks for providing your expertise and the service that you guys offer to this market.
Oh, absolutely, Brady. Great spending this time with you, working with you, and look forward to seeing you in Jackson Hole.
All right. Talk to you soon. Bye-bye.
All right. Take care.